Hey guys, it's Aman
and Christina
from Our Rich Journey.
The stock market is at an all-time high right now, and in fact, it's been on a 9-year bull market run. So if you've been investing, you probably feel like a champ right now.
But on the other hand, if you have not been investing, you're probably afraid to get in the stock market right now. I mean, it's hard when you see news articles saying that the market is at an all-time high and you want to invest. So on today's show, we're going to break down 3 reasons why it's not too late.
Before we get started, if you're new to this channel or you haven't subscribed yet, please subscribe. We do 2 videos a week, and each video is on making money, saving money, investing money, and life hacks. So please subscribe.
Let's get started. So let's answer the question, should you invest in the stock market when it's at an all-time high? And the answer is yes. And the number 1 reason is there will be more highs.
In fact, if you look at the history of the stock market, between 1950 up until today, there have been over 1,200 all-time highs in the stock market.
Yeah, that's amazing. I mean, over 1,200 times, the stock market has hit an all-time high. So we pulled up a chart of the stock market from 1926 till today, and you'll see that there are bull and bear markets. So right now we're in what's called a bull market, where the stock market is going up at a pretty fast pace. So if you look at this chart, you'll see that for every bull market that lasts on average 9 to 10 years, there's a bear market. But the bear markets only last about 1.5 years. Let's look even deeper at this. On average, the bull markets return 476% in the market, whereas the bear markets, you're only losing about 41%. So yes, the stock market will go down, but in reality, the stock market doesn't go down for very long, only 1.5 years. But bull markets, where the stock market is going up as it is now, it goes up for a very long time.
Because there's going to be more highs, it's okay to invest when the market is high. It's high and then it may go down again, as history shows, but history also shows that it goes back up again.
Reason number 2 why you should invest when the stock market is still high is you can't time the market. So what we're talking about here is market timing, where people will try to guess that the market will go down at a certain point and try to buy, and they'll try to guess when the market will go up and they'll try to sell. So this is impossible. Not even the smartest financial people in the world are able to identify the best time to buy and sell the market. So market timing is talked about all the time in the stock market. But what people often say is that it's time to sell because it reached a new high. They talk about the market has gotten too high, the market has gotten too valuable or too expensive. So let's look at some examples.
Let's look at an example of 2014, which is pretty recent. This is an example of a time where everyone that was investing in the stock market and all of the experts were screaming at people that the market is too high and that you should sell. At this point, the S&P 500 closed at over 2,000 for the first time.
So 2,000 is a milestone. It's a nice round number, and it's easy for the media to focus on a big number.
That's right, and if you would have listened to the naysayers and pulled your money out of the market during that time in 2014, you would have missed out on over a 40% return between then and now.
I think another example is when the Dow hit 20,000. That was a huge milestone, and people were saying, okay, this market has gone too high, it has to drop. Well, if you would have sold your stocks when the Dow hit 20,000, you would have lost out on another 30% return between now and then.
This is what we mean when we say you can't time the market. It's impossible to predict how the market is going to move in the future. So the best thing to do is just begin investing now, and in the long run, you'll continue to make money.
The third reason is the longer your money is in the market, the better you will do.
This goes back to what we were talking about with the history of the stock market. If you start investing your money sooner rather than later, history shows us that the stock market will continue to rise and you'll get greater gains from your investments.
And the earlier you invest, the more money you'll have.
And this has to do with dollar cost averaging.
One of the best investment styles is dollar cost averaging. It's a consistent form of investing in the stock market, where on a regular basis you invest the same amount of money regardless of what the market is doing. For us, for example, we invest the same amount of money each month, regardless of what the market is doing. We dollar cost average into the market. Let's use an example to illustrate this. You start investing in the market at its high in 2007, and the market crashes, but you consistently invest money in it. So from 2007 to 2009, the market is still going down and you are still dollar cost averaging into the market. You do that up until today, your money would have returned 85%. So dollar cost averaging is a very powerful form of investing because as the market goes down and as it goes up, you're capturing the average return. And in this case, the average return has been up.
If you look at the chart that we showed, a lot of people are going to say, why would you invest in 2007? Why not just invest in 2008 or 2009 during the crash? Well, the problem with that is that we're looking back in hindsight and we see when the crash happened. In the future, like we said, you cannot predict when a market is going to crash or when it's going to do really well and peak.
Yes, the market is at an all-time high, but history tells us that there will be more highs. It will get higher, it will get lower, but there'll be higher and higher highs. So we hope that you've learned something from this video. One is be consistent. I think that's the number one message that we're trying to give you.
And that's what we've been doing. The market is high and we're still consistently investing the same amount of money that we do now as when the market is low. Like we said, based off of history, the market is still going to get higher, even if it goes lower. The second thing is, again, you cannot time the market. And the third thing is, the earlier you invest, the greater your returns can be. So if you like this video, make sure to give us a thumbs up, subscribe to our channel, and join the journey.